Well, hello, everybody, and welcome to this quarter's Market Outlook and Strategy webinar. My name is Jeff Porter. I'm Chief Investment Officer here at SBSB. And as always, I'm joined by Gary Lyons, Senior Director of Portfolio Management.
Hello, everyone.
And we have someone new to the webinar cast, Walt Knockett. He's a Senior Manager in our department.
Hello, everybody.
So as I mentioned in the last quarter webinar, Walt joined us about 2 years ago from Cambridge Associates, where he was helping manage very large institutional endowment type assets. He came over with a wealth of knowledge. He's both a CFA and a CFP, a great resource to our team, so you're going to hear a lot more from Walt going forward. So let's start this webinar by going over some of the major asset class returns. And first, let's look back to 2017 up top there. What a great year for investing. All asset classes were up very nicely. You got a great bang for your buck, so to speak, if you were a globally diversified investor. And it was the least volatile market in history. So just a wonderful year. Now, Mr. Market is never that easy for that long. So things change quickly, and they certainly did here in 2018. So if we look down to the lower left here on bonds, you see that short-term bonds have increased through September 30th, up 0.5%. The taxable bond universe, represented there by the U.S. Aggregate Bond Index, down 1.6%. And municipal bonds holding up a little better, down 0.4%. So what's going on here? Why are we seeing these red arrows? Well, it's just because rates are rising. For example, the 10-year Treasury bond yield started the year at 2.45%. At the end of September, it was up towards 3.05%. So anytime rates rise, the principal value of your bonds, at least in the short term, decreases. But oftentimes that's partially offset or fully offset by the income that's coming in. So that's what's going on this year. But there are two educational points that I'd like to make here. One is looking back at that short-term bonds, up 0.5%. This is despite the rising rate environment, and that's because shorter-term bonds have less interest rate sensitivity, and that's why we have them in your portfolio. So even if the bond market as a whole, as well as the stock market as a whole, are both down at the same time, we can at least rely on the shorter-term bonds for distribution needs for our clients. So a second main point that I want to make is looking at that U.S. aggregate bond line, down 1.6%. So the worst bond market in history for the aggregate bond index was in 1994, and it was down 2.9%. Now, the reason why I bring that up is because, as many of you probably know, last week the S&P 500 lost 3.15% in a day, and much of that loss just came in the final hours of the afternoon. So it's always important to remember that a bad year for bonds is nothing like a bad year for stocks. So we talked about bonds a bunch in the last two webinars. Feel free to go back and listen to them. But the main gist was that we're seeing classic late cycle inflation. We are seeing wage pressures start to build, and we think that should pin the Federal Reserve back in a corner to the point where they need to keep on raising rates later on this year, as well as into next year. But in terms of how high rates can go, we think the 10-year, for example, won't be able to make it up much more than 3.5, 3.6% or so. And it's due to those structural issues that we spoke about on in those webinars, namely the debt. Because at 3.6% or so, that's going to really slow the economy down to the point where it's going to be very difficult for yields to keep on rising. So one last point on bonds before we go to stocks. Over the past quarter, what we did for most all portfolios is we sold corporate bonds in the shorter term area, and we replaced that with short-term treasury bonds. And this is just to continue the effort of upgrading the quality of our portfolio, because when stocks go down, treasury bonds are an investor's best friend. Okay, so we're here to talk about stocks, so let's move over to the right. You see U.S. large company stocks up 10.6, small company stocks up 11.5. Now, this is through September 30th, and we know things have changed there. But it's important to note that when you look underneath the hood, it's been a really narrow rally. And what we mean by that is, I was looking at data right before the turn of the quarter, and 6 stocks, Facebook, Apple, Amazon, Netflix, Google, and Microsoft, were up as a unit, up around 30%. The rest of the 494 stocks in the S&P 500 were only up 3%. So that's what we call a narrow market. Moving over to the right, the international developed stocks were down 2%. But the big story was in emerging markets, down 8.2% on the heels of issues in Argentina and Turkey, and of course the continued trade war in China. So when we look at these type of returns and the environment as a whole, it reminds us a heck of a lot of the 1990s or the late 1990s. So that's going to be our topic today. We're going to be comparing and contrasting, and more specifically, we're going to ask ourselves 2 questions. One is, are we in another tech bubble? And 2, emerging markets. Are we in or are we headed for another Asian financial crisis? So certainly we could come up with differences between now and the late 90s, but there are a lot of similarities. So you look at economic and monetary policy, both periods were long economic cycles. Back in the 90s, there was a recession in 1991. There was another one in the year 2000, so 9 years in between. Today, our last recession was 9 years ago in 2009. Both periods were marked by low unemployment, extremely high consumer confidence data, low inflation, and easy monetary policy, meaning low interest rates versus historically. So when we turn to markets, both periods had expensive United States stocks. There was exuberance over the technology of the day. As I mentioned, a few large growth stocks were powering the market ahead. When we look overseas, there were both concerns for international debt and currency concerns there, and that has led to U.S. stocks outperforming the international stock market. So as a whole, fairly similar. But let's dig a little deeper and go to our first question, which is, are we in essentially tech bubble 2.0? So, Walt, let's start talking about that.
Yeah, absolutely, Jeff. You really nailed it on the head earlier when you defined this market as narrow. That's really what has dominated financial headlines in recent years. And what we'll focus on in this chart and on this slide is the acronym FANG. And this was made famous by Jim Cramer in late 2015 and early 2016. And FANG represents Facebook, Amazon, Netflix, and Google. And what this chart shows you is some of the previous bubbles over the past 40 years. So it goes on the far left-hand side from gold in the late 70s to Japan and the Nikkei index throughout the 80s to the tech bubble, which we're focusing on in this first section in the mid-90s to 2000, as well as the most recent crisis that was derived from the housing bubble that really built up during the mid-2000s. But if we focus on the red line on the far right, what this represents is the Dow Jones e-commerce index, and that's simply made up of the FANG stocks, so Amazon, Netflix, Google, and Facebook. And these 4 stocks are up well over 600%, which actually is the 3rd largest bubble over the past 40 years. And as a result of this recent increase in price from these stocks, it's produced some pretty interesting factoids. And really, you can see this from Facebook, a company with just over 25,000 employees. Its market cap is greater than the market cap of India, a country built of 1.3 billion people. It's the fastest growing economy today, growing at over 8%. So it just shows that a company in Silicon Valley is bigger than the fastest growing economy in the world, the market cap there. In addition, if we look at the technology sector as a whole, its market cap has exceeded $6 trillion. And that actually today is bigger than the entire Eurozone market cap combined. So as portfolio managers, when we are thinking about both risk and return and where we want to place money in the portfolio, this really sets up some interesting debate. And what we can take away from this is it's important to note that the red line is comprised of only 4 stocks, as opposed to these other bubbles, which made up a whole sector, a whole country, etc. So really, it's not comparing apples to apples. So what we want to do is compare the 4 FANG stocks to what we saw some of the high-flying stocks back in the late 1990s. And what we're looking at on the left-hand side is a similar composite of stocks. We'll call it SimQ today. It's comprised of Cisco, Intel, Microsoft, and Qualcomm. And you can see the chart of this composite from the mid-1990s to its peak in 2000, and then the bubble deflating over the next few years. And what we've done on the right-hand side is, with the same axis, plotted the FANG composite since 2012. And as you can see, when we all looked at these charts, we gave ourselves a pretty quizzical look, because it's a very similar trend. But the real takeaway here is that although it's following a similar trajectory, the move has not been as extreme as what we saw from those late 1990s high flyers.
So, well, this is just comparing 4 stocks versus 4 stocks, but when you look at the technology sector as a whole, it's a pretty similar takeaway, isn't it?
Yeah, absolutely, Jeff. And what this chart shows you here is the information technology sector as a whole as a percentage of the S&P 500. And really, given the rise in price of not only the FANG stocks, but other tech growth stocks, the IT sector now makes up a quarter of the S&P 500, or a little bit above a quarter of the S&P 500 index. And although this is elevated, it hasn't yet reached those peak levels from the dot-com hysteria of the late 1990s. On the left-hand side of the chart, you can see that in 1995, the IT sector made up about 8 to 9% of the index. And when it peaked out in 2000, it was well over 30%. So almost 4x the growth. And then today, looking at the right-hand side and looking at about 2015, the sector has grown from about 20% of the S&P 500 to about 26% today. So although this is pretty extensive growth and we're getting up there, this is a lot less worrisome to us than what we saw in that exponential growth throughout the late 1990s.
That's right. So the last 3 slides here are comparing the 2 periods based off of price action and kind of the movement of prices. But Gary, we know that valuations are hugely important. So let's turn our attention to that. But let's first, for education, remind people why it's so dangerous to invest in very expensive stocks.
Absolutely, Jeff. So here we clearly see the dangers of investing in expensive stocks. Shown here is Cisco Systems, and they design and manufacture internet data, switching, and routing products. That's literally the very backbone of the internet. And so you see there on those blue bars, Cisco's metrics for annualized revenue and earnings per share growth. And they're huge because that company is very healthy. But also there in green, you see the same metrics for the S&P 500, annualized revenue and earnings per share growth. Now, Cisco, as I said, was and is a fantastic company. And in 2000, when investors overpaid for its future earnings, the market euphoria made it all seem so logical. But when you grossly overpay for earnings growth, it can be decades before you make any return whatsoever. So in the data table that's in the middle of the chart there, notice the price to earnings ratio at the end of July 2000. That's in the box on the left side, 174.5, just a massive cost for $1 of future earnings for Cisco versus 26.3 for the same dollar of S&P 500 future earnings. So in the middle of the data table, you see predictably that for the next 17 years, $10,000 invested in Cisco was cut to $5,770, whereas $10,000 invested in the S&P 500 grew to $24,100. Now look at the total return boxes all the way to the right. For that 17 years, Cisco returned minus 42.3%, and the S&P 500, 141%. So the price you pay is always very important to future returns. And you know, Jeff, the most persistent mistake we see investors make is overpaying for growth.
Yep, that's well said. And I just love this example because anybody in their right mind would take a look at Cisco's revenue versus the S&P and earnings per share versus the S&P over this 17-year period and say, that's obviously the best investment. Why wouldn't I want that?
Absolutely.
But too many people, only look at one side of the equation. So it's very important to look at the fundamentals without a doubt, but you also have to figure out how much you're paying for those fundamentals. So I just love this example. All right, Gary, so as much as I love it, this is an extreme example, right? So
Absolutely.
In terms of comparing today versus back in the 90s, let's take a look at a number of the big technology stocks back then versus the big technology stocks here.
Yeah, certainly. Let's do that. So here we see the so-called FAMGA stocks. I know we're hitting you with a lot of acronyms today, but FAMGA is an abbreviation coined by Goldman Sachs for the top 5 performing tech stocks in the market today. That's Facebook, Amazon, Apple, Microsoft, and Alphabet's Google. So on the charts, you see that these FAMGA stocks are there versus the year 2000 tech bubble stocks on the right. In the blue, you see for each one of the companies, their 12-month trailing price-to-earnings ratio. And that's just simply price per share divided by earnings per share. Now, the average of the two groups is there in gold, which for the current group in 2018, you see there is 55. So compare the average 12-month trailing price-to-earnings ratio of 55 to 81 in the middle of the year 2000 for the tech bubble market leaders back then. So 2000's tech bubble had valuations, Jeff, 47% higher than today for the leading group of stocks. And so these current market leaders, yeah, they're expensive, but not like the late 90s.
Yep, expensive, but not as extreme. So when we look at the S&P 500 as a whole and look at the valuations underneath that, what's it telling us?
Yeah, absolutely. So if we take the S&P 500 and break it down into quintiles by price-to-earnings ratio, and quintiles just means 5 equal groups. So broken into quintiles by price-to-earnings ratios, the top 100 stocks have an average annual trailing PE of 76.5 times. So you see that there on the bottom blue bar. The least expensive or lowest price quintile is at the top of the charts, just 9.1 times. Now overall, the S&P 500 index has an average trailing PE ratio of 21 times, and that's the dashed line you see going vertically down the chart. So the demand for growth stocks has moved to an extreme level compared to history. And, you know, Jeff, investors are paying ever higher prices for those growth stocks, but history should suggest that in the long run, cheaper value stocks outperform. So let's take a look here and remember how this played out. As you see here, growth stocks in the S&P 500 are in orange, and they outperformed through the middle and late 90s. After the year 2000, value stocks, and they're there in light blue, outperformed. So markets are rotational, and they rotate based on valuations. And thus we clearly see the dangers of investing in expensive stocks. Now, since 2008 to June of 2018, growth has returned 13.7% annualized versus 9.4% annualized for value. So that may mean a reversion to the mean is eventually likely, and thus outperformance will return to value stocks. And we believe value stocks are where the odds are better with a much larger margin of safety. In fact, since 1929, for every single rolling 15-year time period, value has outperformed growth by a wide amount. Value has outperformed, and you know, Jeff, it's paid to migrate your portfolio to an average lower price to earnings ratio for quality companies, and the key there is quality.
That's right. And it's important to note that, you know, our clients have gained from this growth boom really through their exposure in the S&P 500. I mean, the FANG stocks that we were mentioning make up an amazing 17% of the index. And Walt was talking about the technology sector, over 25% of the index, and that's what's been powering the whole market. The question is kind of what to do. And as Gary says, you know, we think it's very prudent to slice the profits. Consider this as a gift as they go up. Slice those profits off, deploy that money to the more valuable part of the market so you're well positioned when this inevitably shifts. So that will wrap up this first section of the webinar. And we're going to turn to the second section here dealing with the emerging markets. Again, are we in or headed for another Asian financial crisis? So for those of you who aren't familiar with the Asian financial crisis, it was a time period, obviously back in the late 90s, where there were a number of Asian and emerging market countries that had major fundamental and structural issues. They also had a lot of debt. And this all combined to cause major issues in their currencies, a decline in those currencies, and that led to a very poor number of years in the stock market for this group, even though the developed market, especially in the United States, was powering ahead. So what we want to do today is evaluate those fundamentals and see, you know, if we're in the same place or whether we're stronger, weaker, etc. So in order to evaluate the situation from a fundamental standpoint, we're going to look at 5 key factors. The first one is the debt. We want to know how much of the debt is in dollar-denominated debt, and 2 other ways you can call dollar-denominated debt is hard currency debt or external debt versus local currency debt, debt in one's country's own currency. So we want to see more local currency debt than dollar-denominated debt because let's say you're a country, you're borrowing in dollars, and that debt comes due. And for some reason, the dollar has spiked higher. Well, that's going to require a tremendous more of your own currency, the foreign currency, to buy back those dollars to pay back the debt. So you don't want to be subject to the whims of the currency market. So we want to see more local currency debt than external debt. The second factor, inflation. We obviously know that inflation, very high, hurts consumer spending power. It also leads central banks to increase interest rates, and then that filters through and slows the economy. So what we want to see is lower and steadier inflation. The third bullet point, current account. Current account surplus versus current account deficit. We want to see more of a surplus. So what does that mean? That means when a country is selling or exporting more goods and services than it's buying, that means that more money is coming through the door, so to speak, and the savings builds up each year in the form of reserves. So reserves is the fourth bullet point there. Consider that like the piggy bank. You want to have a lot of reserves to spend on your economy. But more importantly, when you hit bad times, difficult times, you want to deploy this money to prop things up as a backstop. So the last factor here we're going to evaluate is economic and corporate growth. This is an easy one. Everybody knows that growth cures a lot of ills, and certainly when you're talking about debt, the more growth you have, the easier it is to service that debt. All right, so let's take a look at ground zero of the issue here. This is what you read at on the top page of the paper, and the headline would say, emerging markets, they have too much debt. So you can see here back in the late 90s or so, there was about $1 trillion of emerging market debt, and that has steadily increased over the years and decades to the point where we're close to about $20 trillion of debt. So that's worrisome, especially when you see since the financial crisis that debt growth has sped up. But again, this is just the headline. So let's take a look at the next slide that has this exact same chart but with more information in it. First of all, in orange there, back in 1995, there were 43 emerging market countries. Fast forward to today, and there's 67 countries. So more countries means more debt, and that's logical. But remember how we were talking about what type of debt is important. And we wanted to see more local currency debt rather than external debt, or in this chart it's called hard currency debt. So take a look at the light blue area there and the dark blue area. And you can see that the majority of the debt today and the majority of the growth, especially since the financial crisis, has been in local currency debt. And that's a lot different than it was back in the 90s, where almost all the debt was external debt. So this is a relatively good thing, we would say. But Gary, there are debts there, external debts in gray and in green. So now let's take a look at which countries are carrying those external debts, and let's also bring in that other factor I was talking about, which is the current account deficit or surpluses.
Absolutely, Jeff. So here we clearly see that not all EM countries share the same issues and debt burdens as you were mentioning. So we see here EM countries plotted with their current accounts as a percent of GDP. That's on the y-axis, and their external debt as a percent of GDP. That's on the x-axis. The weak emerging market economies that are constantly making the news are countries like Turkey and Argentina. And they're struggling to fund their trade and budget deficits while maintaining very high debt levels. However, the big EM countries like China and South Korea, which are nearly 10 times larger, do not share those same burdens at all, as you can clearly see from that chart. More importantly, Argentina and Turkey, those two most troubled economies, they account for less than 1% of the EM index, while the stocks of the two biggest countries there, China and South Korea, they're making up over 45% of the index. You know, out in the press and in the markets, you see what is happening to these EM countries. They just all become lumped together. But they definitely have issues that need to be separated out. Many of them have very strong current accounts and low debt.
Yeah, Gary, I also think it's worth mentioning here, Taiwan is the third largest component of this MSCI Emerging Markets Index, and it's off the charts in a good way. Taiwan has a current account as a percentage of GDP of plus 15% with very little debt. So it's, when you're thinking about China, South Korea, and Taiwan comprising nearly 60%, you have those squarely away in the green area up there. So we've talked about debt. We've talked about current accounts. How does inflation factor into the equation?
Yeah, that's a good point, Walt. So another thing that's really helped these emerging markets are the much lower inflation rates these days. Now on the chart, look at how substantially inflation rates have come down for these emerging market economies. That's the dark blue line, from 12.8% in the 1997 Asian currency crisis to 4% currently, versus the green line there for the advanced economies, generally staying below about 2%. Now, in the IMF's most recent research paper called The Decline of Inflation in Emerging Markets, Can It Be Maintained?, the IMF shows all of the structural changes in monetary and fiscal policy that these countries have implemented over the last decade, and that's significantly contributed to not only far lower inflation now, but, Walt, for the future too. So, and this is critical actually for attracting further investment into these economies, because what happens is this acts as a buffer for any future debt crises.
But Gary, this is looking at the emerging markets as a whole. So let's get a little bit more granular and see where the inflation is or not but also the current account surpluses and deficits like we were talking about. And let's compare it to the 90s versus today.
Absolutely, Jeff. Let's drill down. So on this chart, lower right in red is bad, and upper left in green is good. So here again are the countries involved in the 1996-97 Asian crisis. And where these countries were in 1996, again in red, and today in green. So you see there their current accounts as a percent of GDP. That's on the y-axis. And inflation for those same countries on the x-axis. Again, the red dots are where all the countries were in 1996 on those two parameters, and the green dots are where they are at the end of 2017. So you clearly see here, Jeff, a massive difference in external balances and vulnerabilities exists now, and fundamentals are much stronger now than in the late 90s.
And you're seeing a lot of those green lines kind of above that zero lines, meaning that there are a lot of current account surpluses in these countries. So that means that the reserves should be building up and have been built up over the years. Isn't that right, Walt?
Yeah, absolutely. Jeff, you mentioned piggy bank earlier, and I can't help when I think about reserves hearkening back to when I would go to the mall with my dad and my sister when we were younger, and he would give us each $20 to go kind of spend as we please. And my sister would always come back with no cash left, a Beanie Baby in hand. And I would think hard about it. I would usually come back with a deck of baseball cards, maybe a small bag of candy, but always enough money to place in my piggy bank at home. And that was really my reserves. And it worked wonders for me because I was able to get out of doing additional chores for that extra cash back in the day. But really what this global currency reserves does is it allows these countries to have the flexibility to spend as they please. And there's two main ways emerging market countries can spend. One of them being to stimulate during tough periods. And we've really seen that this year already with China. China is the largest emerging market. It has over $3 trillion of reserves. And just this week, they've actually come out and stimulated the market as their economy has started to slow down a bit. And another way these emerging markets can spend their currency reserves is by investments, in smart investments. And they can invest in technology, which hopefully should boost productivity. And we all know that technology component and the productivity component are two of the main components of GDP growth. And as those continue to grow and they are able to invest that extra money into these technology, then it should bode well for GDP growth going forward for the EM economies.
So let's talk about that. We've hit 4 out of the 5 key factors that we were evaluating. So let's move on to economic growth.
Yeah, this really gets back to the old adage, grow your way out of debt. Right? As these economies grow, they naturally take on more debt. And this helps to explain that rapid amount of debt growth, kind of ground zero that we saw on slide 15. What this data and chart shows you is from the International Monetary Fund's Global Economic Outlook. And it's the percentage of global growth, global GDP growth, attributed to advanced economies like the US, the UK, and emerging market and developing economies, right? So your China, India, Brazil, etc. And what we can see from the data on the left-hand side of the chart is that in the 1980s and 1990s, over 60% of global GDP growth was attributed to these advanced economies. And the remaining, under 40% here, 37%, was attributed to the emerging market and developing economies. Now we flash forward over the next 2 decades to today, and you can see this trend has reversed. In 2018, nearly 60% of global GDP growth is attributed to these emerging market economies as opposed to just around 40% to the advanced economies. And maybe even more importantly, in the next 5 years, the IMF is forecasting that this growth is set to continue and that the trend from 1980 and 1990, those figures have completely done a full flip. And that's important for where we see GDP growth in the years ahead.
Yep. So bigger economies, that means bigger debt, but that's less of a concern with a bigger economy. Now, you mentioned in the next 5 years there's going to be continued growth, but what does that look like from an annualized growth rate?
Yep. So on this chart here, this shows the annual real GDP growth rate for advanced economies and emerging market economies. It's from the same IMF Global Economic Outlook. And the main takeaway here we've circled in red. On the far left-hand side, you can see back in the late 1990s, advanced economies and emerging market economies were growing at about the same pace, a relatively muted, let's call it 3%. And then where that transition happened over the past 2 decades is you saw the gap grow between emerging market GDP growth and advanced economy GDP growth. And that's really how you saw those numbers flip. And if we fast forward to today, you can see emerging market economies are growing at double the rate of advanced economies. Emerging markets are expected to grow as a whole of around 5% in 2018, as opposed to the mid 2.5%. For the advanced economies. Now, the U.S. has been a nice exception to that, getting a quick boost this year from a lot of the fiscal stimulus. But in that IMF study and how those numbers continue to grow of what we looked at in the previous slide, is you can see that gap is actually expected to widen. These emerging market economies are expected to grow at more than twice the clip of advanced economies in the years ahead. And that really bodes well, again, for the future prospect of these up-and-coming economies.
It does. So we've hit a lot of data here. And this data, as well as other data that we weren't showing today, convince us that the fundamentals are much stronger nowadays than they were back in the 1990s. But just like the Cisco example, it's important to look at the fundamentals, but it's also important to look at what you're paying for those fundamentals. So let's wrap up the webinar by looking at valuations. So what you see here is the price to earnings ratio of developed markets. So that's the United States mainly, but it also includes Europe and Japan. That's in blue. And then in green, the price earnings ratio of emerging markets. And focus your eyes back to 1995. And you can see around that time period, the price earnings ratios were about the same. But then, as the developed markets started to outperform each year, a gap developed to the point where emerging markets became relatively attractive, cheap relative to the developed markets. Now, fast forward to that other red circle there today. That gap has already widened. We're not waiting for it to widen. It's already there. And if you look at the green line there and go back to the late 90s, you see that we're trading very near the same PE that it was back then, but we just went over that the fundamentals are much stronger. So that's important when you look at how this thing played out the last time. So as I mentioned, from 1995 over the years ahead, the 4 years ahead, the S&P 500 trounced the emerging markets. The emerging markets got very cheap relative to the S&P, and then it flipped. And then it went on to dominate that over the next 7, 8, 9 years. And the reason why that outperformance was allowed to last was because it came from such a cheap base, very similar to today. So in terms of what we would recommend, it's very similar to the value versus growth story. We'd see this as a gift. The S&P 500 is up, partially irrationally, but consider that a gift. Slice those profits off, deploy them to the more valuable part of the market that will likely win out in the end. So let's finish today's webinar by going over some summary points. So first of all, we believe that today's markets have a lot of similarities. We went over that, but it's kind of to a much lesser extreme, much lesser degree. When we look at the tech bubble, while we wouldn't consider the e-commerce market and the tech stocks today as a bubble, we'd consider them frothy. And because of that, we do believe they're overvalued and likely subject to low returns going forward. In terms of the emerging markets, there are certainly bad apples. There are certainly issues there. But we're underweight those bad apples in our portfolios. And we really believe that emerging markets as a whole are much more fundamentally sound than they were back in the late 90s, and thus have a much lower risk of contagion versus back then. Now, they are extremely volatile. There's no doubt that the emerging markets will get hit just as much, if not more, if the United States goes into a recession. But we truly believe that the emerging market space will greatly reward investors over long periods of time. So, what do you do? What's the strategy? Well, we think investors should always concentrate on the long-term return potential of an investment. And then when it doesn't work out in the short term, use that as an opportunity to rebalance as well as add to positions. So at this time, that means taking profits from U.S. large growth stocks and deploying them into U.S. large value companies as well as emerging market companies. That makes sense to us.
Absolutely, Jeff. So thank you all so very much for joining us today. We so very much appreciate our clients, and we're always happy to talk with you. Call me, call Jeff, call Walt, call your RM if you need to discuss anything, or if you just want to comment or if you have a question. We always enjoy hearing from you.
Thanks a lot.
Thank you, everybody.